Welcome to my video on accounting principles. I'm sure if you're watching this video, you've probably been taking an accounting class online or in school, and you've come across the idea of accounting principles. Some seem obvious, some might not seem like anything at all, might be really confusing and not make too much sense. The reason I'm doing this video is because I believe the accounting principles are, like the Ten Commandments or the Bill of Rights in the accounting world. They are really important. They're the structure um, of the accounting world and really help you learn and retain all the rules that you're going to be learning over the next 6 months or so. You are going to see a few hundred different accounting rules and say, how am I going to memorize all these? Do I use note cards? Do I just fail the class? I say it's much easier to try and learn these 9 general principles that kind of help you retain the knowledge down the road. Okay, so starting on the right column, we'll go from top to bottom. The first one is the economic entity assumption. Just based off that name itself, I really wouldn't know what they mean. However, what they're trying to say is a business business expenses and personal expenses are not one accounting entity. Basically saying, if you're a person who owns your own business, keep your personal expenses on their own financial statements, or you don't have to keep personal financial statements, and keep your business expenses, on the business financial accounting statements. So if you buy a truck for your business, it goes on those. It will go as a expense on your financial statements for that corporation. If you buy a truck for yourself just for fun, it shouldn't find itself onto your reporting financial statements, or else you haven't separated the economic entity. Basically, just separation of personal stuff from business stuff, put simply. The next one, the monetary unit assumption, basically says we're reporting in US GAAP. Report all transactions in the US dollar. That's pretty much it's what they're getting at. You can have foreign transactions in euros or Swiss francs or something. Report them as US dollars. The full disclosure principle is that one is more obvious. The name, it just means if there's something that's going to be important to a lender or investor of some sort, put it into your annual or quarterly financial report with your financial statements. What could that possibly be? Well, our basic financial statements, balance sheet, income statement, statement of cash flows, will have all of our financial obligations on there as liabilities, or all of our expenses will be on the income statement. This is more of telling the investors in words, why did something happen, why something might happen, a direction the company is now going in. Just a way to not surprise investors in the future. Investors don't like to be surprised by bad news. They'd like to know what's going to happen, when it's going to happen, to the best of your ability. I personally think that the more you can put on this, helps you legally in the long run from suits. However, the more you disclose about possible negative activities also will reduce your share price. So I think you can see here how full disclosure, investors' eyes and in the company executive and reporting eyes is probably two different things. Going concern is basically kind of using the accountant to say whether he thinks the business is going to make it or not. you wouldn't really think that that's an accountant's job. It's more of an investment banker, stockbroker, you know, analyst. That's their job to say, this company isn't doing well, this company is doing well. But they kind of use an accountant while auditing financial statements for accuracy purposes. They use us as kind of a, is this person on life support? And they're not telling us. So we're kind of a fail safe for if this company can't make it. And what it really says is, is this company going to be able to operate in the near future? Yes or no. We don't have to go much further than the near future, which is a good thing. And I wouldn't worry too much about this now. If you become an accountant and you take an auditing class, worry about it then. But for now, you should be good. And then materiality, that's another auditing term. It pretty much is saying, nobody's perfect. It's a relative term to the size of a company. Okay, so let's now go to the left column. Let's start with historical costs because it's up top. And the historical cost principle basically just says, we're going to report assets at the price we paid for them, which seems pretty obvious. If we paid $1,000 for a car, we say the car is worth $1,000. Where it doesn't become obvious is where an asset gains or loses value. So let me show you here, and we'll do an example with some land. Let's say we buy some land, and we'll say it's $200. Let's say we buy it on January 1st. So 1/1/13. We lost $200 of cash and we gained $200 of land that day. It was a pretty even day. We still have $200 of assets. Now let's say on 12/31/13 that land is worth $400. It's doubled in value. We're really happy because we only spent $200 for land that now is worth $400. And we'd love to report that into investors. Hey guys, look, our land is worth $400 if we were to sell it today, which is the day that we're reporting on. However, historical cost says no, we will not do that. That is the $400 is the fair market value. $200 is the historical cost. So you'll see, I'm sure you'll see a lot of problems fair market value. This will just be cost. So you're saying, oh wow, that's not fair. My land's worth $400 now. I should be able to show that as a gain. However, that's not the way we do it under US GAAP. It's just, that's just the way we decided to do it. It also works, in the same way. If, say, that land is worth $100, its value went in half, we would still report it as $200 on 1/30 or on 12/31. This should be 12/31. Sorry, 12/31/13. We would report it at $200 still. So in this case, you're like, oh, okay, I got saved. We don't use fair market value under US GAAP. They do under IFRS, that's International Financial Accounting Rules, which we may or may not be going to in the near future. There is an exception to this rule, and it comes when dealing with investments. However, I'm not going to confuse you. We will go into that little exception when we get into investments a long time down the road, so you don't have anything to worry about there. The next principle, as you see, is the matching principle. And what that basically says is we match expenses in the same period they help generate revenues. And you're saying, that sounds a little confusing. What's it saying? Now, to describe it, I'm going to give an example because I find that easier. So I'm going to do an example with insurance that we've paid for. So let's say, we bought some insurance. insurance, 3-year, $900 insurance. I'm sure your textbook will have this 3-year, 900 something, some easy divisible number by 3. Textbooks love insurance and love 3 years. So let's do year 1, year 2, year 3. Okay. So there's kind of 2 ideas, or 2 ways that you can think about accounting for this $900 spent. Now, let's say the transaction happened on 1/1/13. You could say I had a $900 expense for insurance in 2013, and 0 for 2014, and 0 for 2015. Cash-wise, this is true. This is what cash accounting would be. Accrual accounting is not the same, because that $900 helps generate revenue for 3 different years, not just 1 year, for 3 years. So the correct way to do it would be to say $300 for year 1, it helped us generate revenue that year, $300 for year 2, and $300 for year 3. We're trying to make financial statements as accurate as possible. We don't want, an overestimate of expenses in 1 year, and not an underestimate in another year. So I think you can see that, we really only had to pay $300 in year 1. Our financial statements shouldn't reflect $300 of expenses in this year when, it helps us in the years down the line. And then, this principle you'll see applied for all the accrual rules that we'll learn down the road, and I'll keep referring back to the matching principles. So, just to make sure that everyone remembers it. The third principle on this list, the revenue, I just wrote down revenue, but it's the revenue recognition principle. This one is a doozy. We're going to go over the basics now. But revenue is something that is constantly being fought in the court system with when revenue should be recognized by a company. It might seem, pretty obvious of when it should be. However, there are some gray areas, and companies tend to think that they should be able to recognize revenue sooner than the government thinks that you should be able to recognize revenue. And the real idea of it is, revenue should be accounted for when realized or realizable and earned. And you're saying, it's a little confusing. What does that really mean? Well, what it means is, let's put down R and R for realized and realizable. Actually, it should be R. Sorry. R or R. And earned. What does realized or realizable mean? Well, realized means we've received cash for it. Realizable means that we're likely going to get paid. So let's see what a realizable. I mean, let's say we're a wholesale retailer, and we're selling $100,000 of apparel to Macy's. Well, Macy's does not pay me day 1. What they say is, we'll pay you in 30 days. So that gives them some time to get the inventory ready and to start selling some to get the cash necessary to pay me. Well, I don't need to wait 30 days necessarily to recognize that is realizable, because that, I'm likely going to receive that cash from the vendor in the 30-day period. Now, if I'm selling to, maybe the mafia or someone where I know I'm not going to receive any money from, I can't claim it as revenue, because I know I'm never going to receive it. That's basically what realized and realizable mean. Have you received it? Are you, likely to receive it? There are much more detailed rules that we're not going to get into now, because it's just not going to help you out too much at this point, but we will get into them later. In earned, what does earned mean? Well, earned means the services have been rendered or goods have been delivered. And in this sense, you're, if we're selling Macy's the apparel, depending on our terms of who, how it gets shipped, if we own it until it hits their house, or if they own it the second it gets on a truck, when we give our products to the customer, it is earned. And obviously service businesses like an accounting firm doesn't sell a product, they sell a service. So once the service has been rendered, and then you're saying, well, that seems pretty obvious, they have to do something in order to earn revenue. Well, occasionally you get paid, you get prepaid, in which case you shouldn't be recognized as revenue. You get, say someone I require Macy's to pay up front. I'm like, Macy's, I don't trust you. You didn't pay me last time, so I can't. You're not real. You're not realizable anymore. If I ship it and then hope to get paid, I need you to pay 30 days in advance. So Macy's writes a check for $100,000. You're like, oh, there we go. I got my revenue. $100,000 comes in, and $100,000 in sales. Well, the truth is, you received $100,000 30 days before you shipped something, so you can't recognize it until it's shipped. So what do you do with that $100,000? Well, you say it's a liability. So we'd increase cash by $100,000, and we'd increase the liability, saying, we have an obligation to give $100,000 of inventory to Macy's. Once that has been delivered, we can change that liability over to revenue, and now we've earned it. There are a lot of gray areas in this revenue recognition area, and I'm sure we'll be seeing them later on. And finally, conservatism. Conservatism basically says, if you have the choice between two options, one that makes your company look better, or if we have an outcome that we're not sure of, and we have two options, and one's good and one's bad, report on the bad one, the one that makes us look worse. That's basically the idea of conservatism. If if there's two ways to do something, one that makes us look slightly better than it's possible, and one that makes us look slightly worse, take the slightly worse. That's what I'm trying to say. And you're saying, why would we want to make ourselves worse? Well, a company surely isn't going to try and do that. They want to make themselves look as great as possible in those financial statements so that investors pay more. However, investors would like them to show us the worst possible scenario here, so that I don't make a mistake investing my money. And just a good example is, let's say legal liability. Let's say I'm getting sued for, I'm a defendant for $100K. There's rules around, how you report for this, but basically, if I'm getting sued for $100,000, I need to somewhere, and it's possible I lose, I need to somewhere put on the financial statements, I'm gonna lose. Now, I can put it as a liability, based off certain rules that the actual dollar amount, or if I meet other rules, I can just put it in the footnotes as, by the way, we're getting sued, we might lose $100,000. And let's do another example. I mean, that's the way you'd want it to do it. Even if if your business, you're like, oh, we might not lose $100,000. We might win. Well, you have to show the worst case scenario. And let's put it, to show how conservative we are, let's say we're also suing someone for $100,000, and that we know we're going to win this one. We know we're going to win. This guy, the business we're suing or person we're suing, stands no chance. Well, we're actually not allowed to report on that. We can say we're in a lawsuit. However, we don't want to tell investors that we're going to get $100,000 when we're not definite. So just so you can see the conservatism there, we want investors, hopes, we want to we want to underestimate, overperform is basically what our conservatism, principle says. Now, I hope that was helpful. I'm going to be referring back to, these principles over and over again as we go through all the rules in later videos. So thank you very much, and please watch the next video.